A big wave of buying pressure for the US dollar. Is this the restart of the bull momentum? Let's break it down. Okay, before we break things down on a macro level, I just want to remind you, right, as I tweeted last night, it is so important to remain agile and nimble as a trader. Always staying up to date with your finger on the pulse with these ever-changing fundamentals. Like more than ever right now, fundamentals are really driving market direction. Okay, you would have just seen, obviously, with the non-farm payrolls, that bounce there on Friday and how that's potentially shifting the narrative yet again. Okay, this is why you do not underestimate the power of macro knowledge. Having those fundamentals, that understanding, okay, is priceless in this markets, guys, so that you can understand why, okay, we're bouncing, and then, of course, move with that trend, move with that fundamental sentiment, because that is driving the assets that you're trading. I can't stress that enough. And obviously, guys, I'm pushing out a lot of value each week with these little snippets of videos. But if you really want to level up, those that are serious, as I say, I put this all into a beautiful bootcamp, online bootcamp course, which you can digest. It's got hours, okay, of simplified macro level knowledge. I don't know where you can get it more simplified, okay? Because I really break it down and make it actionable and how you tie it in with your technicals. Whether you're a beginner, you're a pro, it doesn't matter. There's going to be a lot to take from that course, from my frontline experience as an analyst. Okay, it doesn't matter your trading style either as well. So you can check that out if you are serious. But otherwise, you know, continue to watch these videos because obviously there's a lot of nuggets dropping in. So let's break the dollar down. A ton of volatility came into play on Friday, surprisingly to the upside for the dollar. Now, let's have a quick recap of the timeline for the greenback, right? Before we dive into these numbers. Remember, at the commence of 2024, we at the TFTC, we were looking for the upside pressure for the greenback, weren't we? Why? Because markets all here at the back end of last year, November, December, they're really intensifying their bets for the amount of rate cuts that we're going to see this year for the United States from the FOMC, because, you know, they were seeing signs of inflation coming down, not by much. It wasn't coming down by substantially. But then data was remaining strong, but they're just pricing in all these rate cuts for 2024. And what did we say? You know, we said all there that was well and truly overdone. The markets were getting carried away with pricing in those expectations. So what did we see at the commence of 2024? Remember, we were looking for this. We were saying the markets were delusional last year, and then they came to their senses and started repricing in their interest rate cut expectations. They got pushed all the way back towards the end of this year, and obviously we're at the middle of the year right now, still no rate cuts. And the probability, as I said, just in general for rate cuts dropped substantially after, you know, and when you look at the back end of last year, in the final quarter, markets were expecting cuts almost every freaking month of this year, you know, of this year of 2024. So the dollar had some edge here. Data was strong. Inflation remained sticky. And then when you look, obviously in May, we saw signs of disinflation. So those selling came into play for the dollar. Remember, we had the lowest CPI, consumer price index, and lower PPI readings, generally speaking. And we've seen other economic indicators just showing that there's signs of deflation, like drop in retail sales, pending home sales falling, you know, signs that the consumer are feeling a little bit of squeeze. And now we're seeing prices and certain economic data points start to cool a little bit. Rightly so, because interest rates remain freaking high, you know. So rightly so, we see an economic slowdown. Now, with the greenback here, okay, just speaking technically before we dive into it again fundamentally, you can see we've maintained monthly support around this 104 area. Can you see that? You see how previously this was former resistance, and then we broke through, new support, and then obviously resistance, new support. We broke above it, support, and it's holding right now that 104 area. Okay, so really we could argue that on this monthly time view, we're still in an uptrend. Okay, after commencing that push to the upside, as I just explained there at the commence of this year. Now, if I want to fast forward, okay, if you look here on a weekly, just quickly on a weekly, first of all, you can still see this arguably trending to the upside. Okay, we could put a trend line there. Okay, you can see our valid points there, tapping that trend line, supporting that price, action to the north. Right now, obviously, we're printing higher lows, can you see? And also higher highs as part of this potential structure to the north, okay? Obviously, we believe that structure could have been broken when that selling came into play with those lower inflation data. But this is what I mean. Let me make this extremely clear, okay? Fundamentals are constantly changing, especially right now. They're extremely delicate. I can't stress that enough. You can't just be like, okay, that's it. we've entered a new bearish trend. This is the given. Any single fundamental can change things, guys. That's the power of fundamentals, power of macros. That's why I always say it, and I always preach you guys, don't I? Okay. Don't I always say it about remaining nimble and agile and just moving with these fundamentals? As long as we've got our finger on the pulse and ready and understand why we've just seen a bounce, okay, or a shift potentially back to the upside in favor of the dollar, then we're all good. Okay, we move with that. We remain agile and nimble. No matter what our views are, we just got to understand things on a macro level, the way markets are digesting it. So look, if we look at last week, let's bring up dollar here. Okay, obviously the big volatility coming into play with the non-farm payrolls numbers. Let's bring those up here on Friday. So guys, just to quickly interrupt this video with an announcement, we're getting very close to launching our PAM service to everybody. We've been running this fully automated market neutral strategy with our immediate TFTC members. And why I like this as well, it's a great way to diversify out of your manual trading. However you trade the markets, just a great form of diversification. You can never diversify too much, especially given current conditions in the market as well, how choppy and changey we are. And why I like this strategy is it doesn't matter which way the markets are trending, and it's fully automated. So we remove that psychological aspect as well. Now you can see, obviously, just going over the stats again, up 50%, drawdown just shy of 18%. It is a medium risk strategy. You can see here 75% win rate. We've got a decent profit factor of 2.41. Look, in the month of April, up 16.27%, strong performance in May of 23.52. And so far in June, right now, we're up basically 5% and expect that to continue to push to the upside. Obviously, we're still very early on in June right now. I will have full details on this in terms of when we launch to everybody. So stay posted on my socials. If you're not following me, make sure you follow me on X. Make sure you're following me on Instagram. Make sure you are in the Discord. If you're not in the Discord, the TFTC Discord, obviously the link is also below. Back to the video. Look here. All right. Bullish data, generally speaking, across the board. If we start off the most important, which is average hourly earnings. Let me make it clear what this is. Average earnings is as an average, what Americans, what the labor force are getting paid for their work, right? If these guys are getting paid more money, what is that in terms of macros? What does that mean for inflation? It's inflationary. You know why. We've gone over it for many, many, many weeks, many months, right? Since we've been in existence. It's inflationary because if people getting paid more money, what do you think they're going to do with this more money, this extra cash that they're getting? What are they going to do? They're going to go out and spend. They're going to continue to buy these goods, use these services of these businesses. And these businesses are not just going to rush to go and put down their price if people are still spending, are they? So that's inflationary. All right. So that's one point there. The second point, look, I still personally, right, you can interpret NFP how you want to interpret. I still take NFP with a pinch of salt, especially data can be easily manipulated. All right. But that's one point. But then the second point is also data can also be viewed in a different perspective when you break it down. So first of all, at plain sight, this is a hot jobs report, and it's very understandable why the market's rallied. Those average hourly earnings, the decent amount of jobs here supposedly added to the economy of 272,000 jobs, though the previous was revised lower down to 165K, which is bearish from 175, okay, different of 10K, not a massive deal, but still being revised lower. So signs still that we are getting that economic slowdown with that revision to the downside. But at plain sight, it's a hot jobs report. Now, let me make something clear, okay? And I saw some of the guys in the TFTC in the chat, you guys mentioned it. So let me cover some ground on it, okay? I had observed this, but I was pretty busy, tied up on Friday. But look here, allied with the official non-farm payrolls number, right, the headline figure, we also get what's known as the household survey, household employment, which is also important not to be overlooked, because with the household, let me make it clear, with the household survey, the household employment, unlike the NFP, this actually includes self-employed workers. Bear in mind, there's a lot of self-employed workers in this world, in the country of America, of course. It also includes farm workers, because remember, non-farms is non-farm payrolls. And then, of course, as well, private household workers. So there's other factors there, other roles that should be considered, right? And here, if you look, the amount of full-time workers declined massively, 625,000, while those holding part-time positions increased to 286,000 jobs. That's a big reduction in full-time employment, which is obviously not covered in the main NFP figure. So at plain sight, the numbers are hot there. But then when you look and dive deeper into the components, the subcomponents of this jobs report, and look at the household survey, household employment, it's not great. Okay, it's not great. So as if I'm speaking from a broader perspective, what I was covering ground on before, where the United States, as I said, we're getting this economic slowdown potentially there. We could get what's known as a hard landing as opposed to a soft landing, where, you know, we've had this period of raising rates, and, you know, as the economy starts to cool, then naturally we should have this soft landing where we don't fall into recession, and then they can start to cut rates. You know, just it's just gradual. It's a gradual easing of that economic cycle. You know how we enter these different economic cycles, which we've spoken about before. But I feel like, especially where there's a number of red flags, we could enter what's known as a hard landing, and we spin straight into potentially a recession, okay, for the United States. So look, that's just my view. Obviously, I'm already babbling on, so I just want to bring it all in again. Look, at plain sight, this is a hot jobs report, but if you look at some of the other components, there are still some cracks in the US economy, basically, in my opinion, and it's very valid indeed. So for now, look, dollar in the latest week, we have staged a rebound at this trend line, and we could end up pushing to the upside. We do have the foundations to do so now, the potential momentum, given these figures, given the fact that particularly average hourly earnings, which is why it's on top here, is inflationary. Okay, it really is inflationary. And talking about inflation, that does bring me on to my point here, where we do have CPI and PPI readings once again for the United States. Okay, when you look here, core CPI expected to remain sticky at 0.3. The month-on-month expected to cool down to 0.1%, but that will probably be just due to the volatile and short-term factors of oil. You would have seen oil price have been coming down quite a bit of late. Commodity price coming down. So obviously that will be why markets are forecasting a lower reading there on a month-on-month. But on a year-on-year, when you stretch things out on an annualized basis, look at the bigger picture, inflation's expected to remain sticky. Right, now this is important. If these numbers do come out sticky and prove to be inflationary, still remains the case there, and we're not coming down fast, okay? Inflation's not coming down fast. Expect the FOMC on Wednesday to push right back. Push back again. Shoo. You know, literally, shoo. You know, all these people that want the rate cuts, that's what they're going to do. Get back. Sorry, I was getting carried away with it. But effectively, they have every right to do so. Okay, given that inflationary, as I say, the wage is still inflationary there, potentially here, the CPI won't be cooling fast enough. So it will just make way for them to have a hawkish stance and push back on rate cut bets. On that point, now look here, okay, in September, now the probability of easing for rate cuts is just 50-50. Okay, remember we were above 60% chance. Look here in November, right? Before this was 90%. Now it's just 64% probability that they're going to cut rates in November. And look at December, 86.3. That was like 100%. So a probability now on the back of that labor market report, and you see, this is what I mean. Don't get it twisted. How fundamentals can just shift and change things. And this has. We had every reason, okay, this dollar to the downside had every reason to head south, because we were seeing data worsening. We were seeing inflation coming down, but now we've bounced again. Okay, things are still potentially inflationary, and we will keep an eye, obviously, come Wednesday with these CPIs, come Wednesday with the FOMC rate decision. They could push back markets in this rate cut pricing, and this, you know, these probabilities could drop even further, which would mean obviously dollar is going to head to the upside. Okay, guys, now have your finger on the pulse and ready for that, because that is going to be huge. Okay, so big volatility around the dollar. I hope you found value in that video, guys. Make sure you do smash up that like button for me and subscribe if you're not subscribing, because it does keep me motivated in wanting to produce this value for you guys. Stay lit, stay blessed, and let's get it.